Is your city one of the ticking time bombs in the U.S. housing market? With mortgage rates soaring past 7%, insurance premiums topping $5,000 in some regions, and home prices inflated by over 60% since 2020, things are starting to look shaky. In places where the average home now costs $500,000 plus, but incomes are stuck below $70,000, buyers are pulling back, listings are piling up, and price cuts are everywhere. Could a housing crash be just around the corner? In this video, we're uncovering 10 U.S. cities where the housing market is on the brink of collapse. Number 10. Huntsville, Alabama. So, Huntsville, you've probably heard it's booming, right? NASA's backyard, shiny tech hubs, and all that rocket science flair. But here's the twist. What went up is now slowing down. Fast. This once it city for affordable living and job growth is now sending signals of a housing slowdown that buyers, sellers, and investors should all pay attention to. From 2020 to 2024, home prices in Huntsville shot up over 50%, landing the median price around $315,000 today. Sounds affordable by national standards. But for locals making a median household income of $60,000, things are getting tight. Mortgage rates climbing above 7% in 2024 didn't help either. Suddenly, that dreamy three-bedroom in the suburbs is looking less like a bargain and more like a burden. And get this, inventory is spiking. Compared to last year, there's been a 32% jump in listings, with homes sitting longer on the market. Sellers are chopping prices. Price reductions on Zillow are up 26% year over year. That's a pretty clear sign of a market shift. Another factor? Overbuilding. With all the hype around Huntsville, developers went all in. Tons of new housing units popped up, especially in suburbs like Madison and Meridianville. But demand isn't keeping pace anymore. Vacancy rates are starting to creep up, and construction loans are tightening. Now, let's talk jobs. Yes, defense and tech jobs are stable, but layoffs in nearby industries and fewer remote workers moving in mean demand is cooling. And if big tech hiring continues to freeze, that buyer pool gets even smaller. In short, Huntsville's housing market isn't crashing yet, but it's definitely wobbling. If the economy takes a broader hit in 2025, Huntsville could be one of the first mid-sized cities to feel the pinch. It's still a beautiful place, but right now, it's a market on thin ice. Number 9. New Orleans, Louisiana. New Orleans has always been a vibe, a city drenched in culture, jazz, gumbo, and southern charm. But let's be real. Behind the French Quarter and Mardi Gras glitter, the housing market here is quietly slipping into dangerous territory. In 2025, the Big Easy may be anything but easy for homeowners and investors. The median home price in New Orleans now hovers around $268,000, which might sound modest, but wages haven't kept up. The average household income is just over $47,000, meaning housing affordability is way off balance. In fact, housing costs now swallow more than 40% of monthly income for many residents, way past the recommended 30% ceiling. What's scarier? Listings are piling up. The average home now spends 90-plus days on the market, and price cuts are everywhere. 1 in 4 listings slashed their asking price in the past 60 days. Meanwhile, insurance premiums have gone through the roof. Thanks to hurricane risks and major insurers exiting Louisiana, homeowners are now paying over $4,000 a year just for property insurance. That's nearly double what it was 3 years ago. Population loss is another red flag. New Orleans has lost over 44,000 residents since 2020, according to U.S. Census data. Fewer people mean less housing demand, and that's a recipe for price drops. Combine that with a rising crime rate and infrastructure struggles, and buyers are getting cold feet. To make things worse, construction hasn't stopped. Developers continued building throughout the 2020s boom, but the demand just isn't there anymore. Vacancy rates in some neighborhoods are climbing above 12%, especially in higher-priced homes. If mortgage rates stay high and wages stay flat, New Orleans is poised for a significant housing correction. It's still a soul-filled, unforgettable city, but when it comes to real estate in 2025, this jazz-filled gem might hit a sour note. Number 8. Denver, Colorado. Denver's mountain backdrop and outdoor lifestyle lured thousands of newcomers over the last decade, but the housing market here is beginning to feel like thin air at 10,000 feet. After years of dizzying growth, the mile-high city is buckling under the weight of unaffordability, oversupply, and waning demand. The average home price in Denver currently sits at $581,000. That's more than 8.5 times the city's median income of around $67,000. In 2012, that ratio was closer to 4 first now. It's a stretch even for dual-income households. And mortgage rates in the 6.5% to 7.2% range are making it worse. A typical 30-year mortgage here now exceeds $3,600 a month, and that's before taxes and insurance. Inventory is rising fast. As of early 2025, Denver has seen a 14% year-over-year increase in available homes, while buyer activity is down 22%. Days on market have nearly doubled, from 21 to 41 days on average, and over 30% of listings are dropping their prices. There's also a wave of sellers who bought during the pandemic boom at inflated prices. Now underwater, they're trying to sell before bigger losses hit. But many are finding few takers. Job growth isn't saving the day either. The tech sector in Denver has slowed, with layoffs across several major employers, and remote work trends are reversing. That means fewer high-income transplants are arriving, drying up demand for luxury homes and condos. On the rental side, overbuilding is causing havoc. New apartment complexes are still opening, yet vacancy rates have jumped to 8.2%, pushing rents down and discouraging investors from buying more properties. Simply put, Denver's housing market is cooling fast. Prices aren't crashing yet, but all signs point to a correction that could snowball if the economy dips further. In 2025, this Rocky Mountain darling might take a tumble. Number 7. Boise, Idaho. Boise was the golden child of the pandemic housing boom. A quiet, beautiful city that suddenly became America's relocation hotspot. But now, in 2025, that golden glow is fading fast, and the market looks primed for a serious correction. Home values here exploded nearly 80% from 2020 to 2022, with the median price peaking around $515,000. But here's the kicker. The local median income is just $66,000, making Boise one of the most overpriced markets in the U.S. Today, home values are already down nearly 12%, and the decline hasn't stopped. Inventory? It's up 35% year over year. There are more listings than buyers, especially in the $500,000 plus range. Houses that once sold in hours now sit on the market for 60 days or more, and nearly 40% of sellers are cutting their prices. That's a sign of serious buyer hesitation. What caused the reversal? First, remote workers are no longer flooding in like before. Companies are calling people back to the office, and Boise's job market isn't diverse enough to absorb the loss. Second, construction went wild in 2021 to 2024. New neighborhoods popped up faster than demand could keep up. Now, those homes are sitting empty, and builders are offering steep discounts. Renters are feeling it too. Average rent prices dropped 5.8% over the past year, and vacancy rates hit 10%. Investors who bought in during the hype are bailing out, especially those facing negative cash flow due to falling rents and rising interest rates. Plus, Boise's population growth has slowed. After peaking in 2021, new arrivals have declined by 21%, meaning future demand isn't there to hold up prices. In short, Boise is in for a rough ride. If the national economy slides into recession, Boise could be among the first cities to tumble hard. It's still a scenic spot with great skiing and charm, but in 2025, its housing market isn't looking so picture-perfect. Number 6. Miami, Florida. Miami might be sunny on the outside, but its housing market is starting to show serious storm clouds. This city was the poster child of the post-COVID boom, with everyone from New Yorkers to international investors pouring in, driving prices through the roof. But in 2025, that heat wave has fizzled into a market that's cooling, and fast. Let's start with prices. The median home in Miami now costs about $580,000, up over 60% since 2020. But that's where the good news ends. Local incomes haven't kept up. The average household earns just $57,000. That means buying even a modest home now takes 10+ years of income. Affordability index? Through the floor. Inventory is surging. Active listings are up 28% compared to last year, and more than 30% of homes are seeing price cuts. Condos in particular are struggling. Downtown Miami units are lingering on the market for over 90 days, and the Airbnb bubble is deflating with new regulations and lower returns. Another issue? Insurance. Florida's property insurance crisis is hammering homeowners. Premiums in Miami-Dade have jumped to a staggering $6,000 to $8,000 a year, pricing out buyers and scaring off investors. Foreign investment is also retreating. For years, buyers from Latin America propped up the market, but with stricter banking laws and political instability abroad, that wave is shrinking. In fact, international real estate transactions in South Florida are down 41% year over year. And then there's climate anxiety. Rising sea levels and increased hurricane risks have put long-term concerns into buyers' minds. FEMA flood zone redesignations in 2024 pushed up costs even more. So, is Miami still glamorous? Of course, but its housing market is not what it used to be. In 2025, the city might still be hot, but the real estate? Ice cold compared to just a couple years ago. Number 5. Nashville, Tennessee. Nashville's country tunes might still be topping the charts, but its housing market is starting to hit a sour note. The once underdog city became a breakout star during the pandemic, attracting remote workers and investors alike. But now, in 2025, that housing harmony is falling out of tune, and fast. The median home price in Nashville is sitting around $460,000, which is up over 45% since 2020. But the city's median income? Just $65,000. That means buyers are paying 7 times their annual income for a home, a huge affordability gap. And with mortgage rates bouncing between 6.5% and 7.3%, that dream home is turning into a financial nightmare for many. Listings are up, way up. There's been a 30% increase in homes on the market since last year, and sellers are getting nervous. Nearly 35% of listings are now seeing price cuts, and homes are staying listed for an average of 52 days, double what we saw just 2 years ago. What's causing the slowdown? For one, demand is cooling. The remote work crowd that once flooded Nashville is shrinking as employers call people back to the office. Also, property taxes are up, and locals are feeling squeezed. On the supply side, developers went wild between 2020 and 2024. Thousands of units were added, especially in neighborhoods like East Nashville and the Nations. But demand hasn't kept up, and many new builds are sitting empty or offering incentives to sell. And let's not ignore the investor pullback. Airbnb regulations tightened, rental yields dropped, and short-term rental properties are flooding the resale market. In short, Nashville is losing the real estate rhythm. It's still got charm, great food, and a vibrant vibe, but 2025 may bring a housing correction that's more dramatic than a country ballad. Number 4. San Antonio, Texas. San Antonio's housing market exploded in recent years, riding the Texas wave of population growth and affordability. But now in 2025, it seems like this city might have gotten a little ahead of itself, and the numbers are beginning to show some serious cracks in the foundation. Here's the scoop. The median home price in San Antonio is around $305,000, up 42% since 2019. That's great if you bought early, but not so great if you're a buyer in today's market. The city's median income is just $56,000, and with mortgage rates above 6.8%, that makes monthly payments of $2,300 to $2,500, a heavy lift for most families. What's really striking? Inventory has exploded. There's been a 38% increase in available homes year over year, and builders are offering aggressive discounts just to move new units. Price cuts are happening in nearly 1 in 3 listings, and days on market has jumped from 28 to 63, a sign that buyers are pulling back. And speaking of overbuilding, the construction boom in suburbs like Cibolo, New Braunfels, and Schertz has led to a glut of cookie-cutter homes with fewer takers. Builders are sitting on inventory, and interest from out-of-state buyers is cooling as Austin and Dallas markets also correct. Another issue? Investor burnout. With rising property taxes, stricter short-term rental laws, and flattening rents, San Antonio's once popular rental market is losing its luster. Average rent has dipped 3.5% since mid-2024, and investors are offloading properties quickly. Add in concerns about local job growth slowing and inflation still pinching budgets, and you've got a housing market primed for a reset. San Antonio still offers a rich culture, a low cost of living, and the famous River Walk. But its housing market? In 2025, it's walking a fine line between correction and full-blown crash. Number 3. Dallas, Texas. Dallas is famous for doing everything big. Big homes, big highways, big hair. But in 2025, it's also facing a big problem. Its housing market is stumbling under the weight of rapid expansion, rising costs, and shifting demand. If you've been watching the numbers lately, Dallas is flashing all the signs of a major correction ahead. Let's start with the basics. The median home price in Dallas is now around $426,000, up nearly 60% from pre-pandemic levels. But the city's median household income? Just about $67,000. That puts the price-to-income ratio well past the sustainable sweet spot. And with mortgage rates hovering between 6.7% and 7.2%, monthly payments on that average home now run about $3,300. Inventory is swelling too. Active listings are up 34% year over year, while buyer activity has dropped 22%. Homes are now spending 50 days or more on the market, and over 30% of sellers are reducing prices. It's no longer the bidding war frenzy of 2021. Buyers are hesitant, and investors are starting to backpedal. One big culprit? Overbuilding. The Dallas-Fort Worth metro added tens of thousands of new homes during the boom, especially in places like Frisco, McKinney, and Plano. But demand has cooled, and many of those brand new homes now sit unsold or are being heavily discounted. Corporate layoffs have hit the region too, especially in tech, telecom, and logistics sectors. That's dampening demand just as supply surges. Rental returns are shrinking, especially with rising taxes and tighter regulations. Short-term rentals that once earned big returns are now sitting vacant or being flipped back onto the market. Dallas still has the grit and growth potential long-term. But in 2025, the market is out of rhythm. Prices climbed too high, too fast. And now, gravity is doing its thing. If there's a broader economic dip, Dallas could take a hard fall. Number 2. Austin, Texas. Austin was the hottest market in the country for years. Tech jobs, music vibes, zero state income tax, and an unstoppable migration wave. But in 2025, the same rocket fuel that launched it into the housing stratosphere is turning into a fiery crash landing. The correction is already underway, and it's picking up speed. Home prices in Austin soared an eye-popping 72% between 2020 and 2022. The median home price peaked at around $570,000, but today it's already slid back to $519,000, a 9% drop and counting. That's still crazy high compared to the city's median household income of $78,000, meaning affordability is way out of whack. So what changed? First, mortgage rates. At 6.8%, the average monthly mortgage payment here is pushing $4,000, completely out of reach for most buyers. Second, tech layoffs hit hard. Companies like Meta, Google, and Oracle trimmed their Austin workforces in 2024, pulling the rug out from under local demand. Inventory is also exploding. Active listings jumped 39% compared to last year, and nearly 42% of homes for sale have seen price cuts. Builders in communities like Leander, Georgetown, and Pflugerville went all in during the boom and are now slashing prices and offering incentives just to stay afloat. Add in skyrocketing property taxes, some up over 25% in 2 years, and a cooling rental market, and investor interest is fading. Rents have dropped 4.1% year over year, and short-term rental restrictions are forcing many Airbnb owners to sell. Even migration has slowed. Fewer Californians are moving in, and those who did are now rethinking it thanks to rising costs and lower returns. Austin still has a vibrant future, but in 2025, the party's over for the housing market. It's no longer about how high it can go. It's about how far it's going to fall before it finds solid ground again. Number 1. Phoenix, Arizona. Phoenix, the hottest housing market of the past decade, that's now dangerously close to meltdown territory. If there's one city that's flashing red on every housing dashboard in 2025, it's this one. The median home price in Phoenix is sitting around $429,000, up over 70% from pre-pandemic levels. But the city's median household income? A modest $66,000. That puts the affordability index in the danger zone. A typical 30-year fixed mortgage now costs homeowners around $3,200 a month, and that's squeezing budgets like never before. What's worse? Inventory is swelling like a monsoon. Listings are up 31% from 2024, and homes are sitting on the market for 60-plus days on average. Nearly 45% of homes listed in Maricopa County have reduced prices. That's not a cooling, that's a full-on market reversal. Another problem? Mortgage delinquencies are quietly ticking up. Foreclosure filings rose 18% year over year, a worrying sign that financial stress is building among homeowners who bought at the top. Phoenix also faces population slowdown. Growth dropped from 2.3% in 2021 to just 1% in 2024 as remote workers look elsewhere and retirees weigh the rising costs of utilities and insurance in the desert climate. Let's not forget overbuilding. Developers flooded the market in places like Buckeye, Queen Creek, and Surprise. Now, those homes are sitting unsold, with incentives like 2-to-1 buy-downs and cash back to close. The rental market's not much better. Rents are flat, vacancies are climbing, and short-term rental saturation is cannibalizing returns. In short, Phoenix looks like a textbook bubble, rising fast, inflated beyond fundamentals, and now deflating just as quickly. If 2025 brings economic tremors, Phoenix might not just wobble, it could crash hard.